It's Larry McDonald with the Bear Trap Report. Great to have Craig Shapiro here. Welcome to the Lens. We have probably in the world, we have one of the largest platforms of institutional clients in the world. We started this conversation with institutional investors in 2010, and because of the first book was A Colossal Failure of Common Sense. We did 140 speeches in 16 countries. The best part was meeting so many talented investors around the world. And Craig all day has been running our Discord platform where we're bringing that kind of intelligence gathering from the institutions directly to investors, family offices, financial advisors, high net worth individuals. Craig, you've been running the Discord all week. It's a great lens on a buy side conversation. The sell side tries to produce research, right? And then always tries to sell you something as an axe there. Today, what are the major, we want to give the audience like a lens, like what was the major takeaway from today and from this week?
Yeah, Larry, thanks. I think the biggest, takeaway in the conversations we've been having all week has been, not surprisingly, around the election and around the odds of Trump winning have been improving all week, and the odds of a Republican sweep have been going up all week as well. And so the market has increasingly started to price in that reality, or at least the probability of that reality going up. And so you're seeing that in the bond market, where yields have moved up broadly all week. I mean, they're a little softer today, but we've had a pretty big move and bond sell-off on back of, look, some better than expected U.S. economic news, but also the idea that a Trump White House and a Republican majority means bigger deficits. It means tax cuts, and it means tariffs, more inflation. And so the bond market is starting to maybe get a little nervous on that front. We're also seeing that in FX. The euro has weakened most of the week. The yen has weakened most of the week. The RMB is weakened this week. These are areas that are likely, at least for Europe and for China, are areas that are likely to see an increase in tariffs that come with a Trump White House win and Republican sweep. So the market is starting to sniff that out a little bit more, and clients are definitely talking about that more and trying to figure out, other ways to play a Trump White House win, whether it's private.
And so we, when we've had periods over the year where we've been bear steepening, where the long end is actually going higher in yield. Is it been more bull steepening or bear steepening this week? In other words, if we're pricing in a Trump victory, then that move up in yields, what I've noticed, and we'll get into this in the presentation, but that move up in yields has caused a tremendous amount of bifurcation in the regional banks. So the last 3-4 weeks, the regional banks have been very strong pricing in a Trump victory on a deregulatory platform, right? And that's another very strong sign for Trump. In other words, why are the banks parabolic? Texas Community Bank shares is like the most overbought, and it's one of the most overbought in 5 years. So you've got the regional banks going up, but then the last 2 days with the move up in yields, right? The last ones this week and last week, especially this week, I've noticed some big divergences in the regional banks where, that higher interest rates is kind of causing some pain there.
Yeah, it seems like this week has been a little bit of a shift in the narrative across the board, that the original, let's say, I don't know if it's euphoria or benefit of this deregulation regime and lower taxes regime is being now offset by concerns on tariffs, concerns on forward inflation. And so this week we've seen, not today, but up until today, we've seen a reasonable bear steepening. And so, typically that's been a trouble spot.
And that's, for the layman, that's bear steepens when the long end, so the 30-year yield, normally when the curve steepens and when the Fed starts cutting, the front end comes down, right, in yield, and the back end maybe comes down a little bit, but the front end comes down more. Bear steepening is when we lose control of the long end.
Correct. But actually what we're seeing is that, because the data has come in okay since the Fed meeting about a month or so ago, where they cut 50 basis points and suggested a fairly aggressive easing cycle. The market has kind of reacted violently against that, and almost signaling that this has been a bit of potentially a policy mistake by the Fed, as inflationary concerns are starting to find their way back into the market. And so with the data coming in better over the course of the last several weeks, we've priced out some of those rate cuts. And so that's the bear part of the bear steepening. So it's actually been all yields have been moving up. It's just that the yields on the long end are moving up faster than the yields on the front end. And so, look, I think across the board, what we're seeing is clients talking about an economy that has been more resilient than expected, pricing out some of this recessionary fear, and also clients thinking about life on the other side of November 5th that may look like a Republican-led White House, Senate, and House, and what kind of economic environment might that lead to with animal spirits, deregulation, tariffs, and bigger deficits. And so
Okay.
we're seeing that for sure.
So I've done in the last 3, 4, 5 weeks, we've done ideas dinners in New York, Zurich, Geneva. It's been and Munich a little bit. We had the Oktoberfest, we had a small event there. But the ideas dinners where we bring and anybody who wants to join us on the Bloomberg terminal, please reach out to us on Bloomberg. But we run a conversation with some of the investors globally. And the biggest thing that I am hearing, you can see a trend shift in thinking, and this is like every time there's an election, the administration does whatever they can to win. And Bush did this. We talk about this in my first book about Lehman, A Colossal Failure of Common Sense. There's a lot of things that were done that in 2007, 8 to try to get the Republicans back into the White House with McCain. And what I've noticed is more and more people, especially on the rate. I talked to a guy that one of the biggest rates, like fixed income managers in London yesterday. He's like, listen, Yellen has issued so many T-bills. In other words, she's stacked the deck with T-bills to try to suck bond volatility out of the market. The next Treasury Secretary or next year, that's going to have to be addressed. And that, I think if you look at the cash bonds versus futures, there's this tension building, and where the United States is listen, we're still the bedrock, the foundation of the global bond market, but we've become like a tiny bit, like 1-2% more, maybe 3% more like an emerging market country. And that's this kind of crisis that we're going to have in the first quarter around terming out the debt, because she issued so many T-bills, which don't move in price. You know what I mean? Now, whereas longer dated bonds move like this. So she was able to suck a lot of bond volatility out of the market by issuing so many T-bills. But now this RRP is getting drained really fast. And Scott Skirms made some comments, like Skirms made comments like, if the RRP gets, now explain to the layman, like, what's happening here with the RRP? Why is it fall? How much did it fall this week, and why is it falling so fast?
Yeah. I mean, basically, you can see from this chart here, the RRP is really a facility that was created by the Fed to kind of mop up excess liquidity. And so the Fed pays a high rate of interest to banks and to money market accounts to store money at the Fed and not put that money
So it's a
back.
higher rate than the money market fund, right? Like, in other words,
right. You're borrowing every day from the Fed at Fed funds minus 5 or 10 basis points, whatever it is. So it's a very attractive rate. It is the highest. For a while, it's been the highest rate on the board, and so there's incentive to keep it there. But you can't use that money as collateral to lend to other accounts. So there are reasons why folks don't use it. But so what's been going on is as Yellen has issued more T-bills, which have other properties than just yield, you can use those as collateral to engage in further lending and speculation. We've seen her kind of mop up a lot of that excess liquidity. And so she's taken.
So in other words, so when she issues a lot of T-bills, the yield in those T-bills goes up, and that's competing with the RRP, and that sucks money back toward T-bills away from the RRP, and the RRP goes down.
Exactly. And so we've seen basically a $2 trillion decline in the reverse repo facility over the course of the last 15 months. And what that means really is that there is less ability now.
Why should an investor care about that?
Look, I think it is still a little bit of inside baseball, because the banks have, for the most part, system liquidity and bank reserves are very abundant still. And so you look at, there's over $3.5 trillion of bank reserves, and then this is extra money that's kind of sitting out there. So there's still a lot of liquidity in the system that's available to banks, should they need it. That being said, there are certain banks, some regional banks, some smaller banks, some banks with highly levered balance sheets, exposure to commercial real estate that are having more difficulty finding cheap capital. And so as this money, gets returned to the system, whether it goes into T-bills, those banks that need capital are finding a little bit more trouble attracting that capital at an attractive rate of return that allows them to lend it out profitably and earn net interest income, particularly in an environment where the Fed is starting to cut rates. That net interest income concept for these regional banks is coming under pressure. And so they have, a reduced ability to make money. And so that's what we're seeing on the margins. At the end of months, at the end of quarters, there are some funding squeezes that go on. But the bigger issue really is next year, as you mentioned, if we have another 1.8 or $2 trillion added to the deficit, which at this point is expected, and we're talking about 6, 7, 8% of GDP, Treasury is going to eventually have to start to term out the debt and issue further out the curve, whether it's in 2 years, 5 years, 7s, or even further out, whether 10s, 20s, and 30s. I mean, there is just less ability for them to issue all of these incremental borrowings at the front.
So they issue more longer dated bonds, and that puts even more pressure on yields.
That's right. That'll put more pressure on yields out the back. And that is more, as the Fed is cutting rates, that's more likely to steepen the curve. And so what winds up happening is an investor has to make a decision in order, if they want to buy a 10-year bond, they want to buy a 30-year bond, and they have to take capital from somewhere else in order to buy that security versus T-bills. There's really no decision. T-bills are cash light, they're money good. And so as investors are being forced to purchase securities further out the curve, that money's coming from somewhere else. And so that could put pressure on other asset prices.
And think about banks. I mean, think about all the bonds that were sold, all the loans that banks participated in 2018, 19, 20, 21, when rates were zero, 1, 2, 3, rates were not, very, very low. So banks like US Bancorp, I mean, their balance sheets loaded with crappy loans at like 1, 2, 3, not 1, but like 2% loans that are now like 8% loans in the free market. So those loans are probably trading at 60, 70 cents on the dollar. And that, it's kind of weird that US Bancorp's underperforming the S&P since 2001 by like almost, is it 40%? Something like that, 35, 40%. I mean, it's the 5th largest bank in the United States. So it's made a big recovery here on the deregulatory track of potential of Trump. But like you said, if that long end and the interest rate risk comes back, then the banks like this are going to have a problem. And that kind of explains why the market has been punishing this bank relative to the S&P.
Yeah. And so, next week, Treasury will give an update on their expectation for the deficit in the first quarter and their expectation for borrowings, whether it's in bills versus bonds. And so there's no expectation that Yellen, in her last meeting as Treasury Secretary, will decide not to increase the issuance of duration bonds. She doesn't want to spook anybody, particularly 3-4 days ahead of the election. But there is a chance that she would have to articulate that in the coming quarters or sometime next year, Treasury will be forced to start addressing some of this concern, and some of this debt will have to start being turned down. I mean, Treasury,
or what I hear from guys and on the Hill, and we're talking to institutional investors, if Trump wins, the next Treasury Secretary is just going to term out the debt and blame the previous administration. He's going to host a press conference and said, make it very clear that we were put in this box, right? That the Treasury issued a very crazy, insane amount of T-bills in order to prevent bond volatility in the election year. And now we have to term it out. And it's just going to it's almost like Jimmy Carter, Reagan, they're going to blame everything on the previous administration. One thing, Craig, that people were talking about today in the institutional chat is the way that in 2007 and also in 2018, the way Winnebago is like kind of a classic, RV, middle class facing, company facing middle class consumers, right? And you notice in 2018, it rolled over. You remember the Fed was hiking rates and financial conditions were much tighter then in 2018. But Winnebago rolled over right, what about 4 months, 5 months before the market did. And if you look at here, it's been, and that's on the left side of the screen. On the
Yep.
right side of the screen, Winnebago's been underperforming all year. And I think it just speaks to like this, like there's a lot more pain on the consumer side because the high net worth individuals are spending money. You look at American Express, you can look at the airlines, there's a lot of people spending money. But this is a major RV, this is
Yeah.
a massive consumer, leading indicator right here.
Yeah, look, I think, it's difficult to follow every single company, but it's good from the chat because what we're getting in from our clients is interesting companies that are market leaders in different segments or what people are most focused on. And so yesterday when Winnebago reported, we were talking about it all morning. I mean, they talked about, I was reading here, sluggish retail demand environment and operating inefficiencies. RV industry continues to face headwinds, including uncertain retail conditions, higher inventory carrying costs, and elevated inventories in motorhome segment, continued dealer hesitancy, increased promotional efforts. And so, clearly a bellwether in the RV industry and kind of a leisure travel and more of a middle income type purchase. And so, sure, I think it really bodes, gives an impact on what we're seeing in this economy, in this K-shaped economy where the top higher end consumers and those with assets are still doing well, but more and more folks are finding themselves in that lower part of the K, W-2 workers without assets that are living paycheck to paycheck and are struggling more in this economy where, yes, the rate of price increases, inflation has come down, but absolute prices are still high. And we saw this morning continuing claims made a multi-year high today. This week is more folks are finding themselves in the unemployment ranks.
And that means that people that are staying unemployed,
unemployed. So they get unemployed and finding out.
In a hot market, you can lose your job and then get another one. But continuing claims is like, that means you lose your job and you can't find another one.
That's right. That's right. So, certainly seeing more pressure now in the labor market. It's subtle. It's not, we're not, finding ourselves into a colossal calamity tomorrow, but every week, every day that goes by, it seems like more people are finding themselves in the lower part of that K part of the economy. And, inflation is not really rapidly returning back to target. And certainly prices aren't moving materially lower. And so most, middle and low end consumers are feeling it. And you're seeing that in many of the stocks, whether it's in Winnebago, whether it's in the dollar stores, which we've been talking about for a bit. Dollar Tree and Dollar General have really struggled. Some of these restaurant names as well have struggled. So definitely picking up on that throughout the course of the chat.
So on the hard asset stuff, about $1 trillion is left the NASDAQ 100. So the NASDAQ 100 had like 24.5 trillion, and now we're probably a little bit above 23 now. So there's definitely some money's moved into hard assets this year. Obviously, gold's crushing. Gold miners are crushing the NASDAQ. A lot of gold miners, silver miners are crushing a lot of the Mag 7. Some of the Mag 7s being destroyed by metals companies. You know what I mean? You don't hear that on CNBC. But the Palladium play, we have trade alerts that go out on WhatsApp, and we've been recommending the Palladium names, Impala Platinum as well. Now, you had a situation with the war in Afghanistan. The war in the Ukraine, where we were supposed to all these trades, Craig, when the war started took off, like because the amount of production of palladium and platinum that are in Russia. So the Wall Street, the pitch was that immediately the U.S. would sanction a lot of these valuable assets in the world, important assets like platinum and palladium for auto production, and we never got around to it. So these you could see here on the chart, 2022, these things hit, they were up like 300%, some of these metals companies, but then obviously the war took place and we never sanctioned the platinum and palladium. And then over the G7 last night, now it looks like they're finally getting around to it. So it's amazing how hard this business can be sometimes, because it was a thesis that made sense. But now, if that's the case, because of all the platinum and palladium in the world, You saw a big move this week in palladium and platinum, but mainly palladium, especially much more so than palladium.
Yeah.
And then, Craig, what are you hearing like in terms of hybrids and that impact versus auto sales and that impact on catalytic converters and palladium?
Yeah, I mean the bear thesis for Palladium for the last several years has been the penetration of electric vehicles, right? I mean Palladium, biggest end market for Palladium is into catalytic converters, into traditional internal combustion engines for regular cars, and so as EVs take more share, particularly in China, because China is the biggest market for Palladium demand and the biggest car market, and uses and also Palladium goes into gasoline catalytic converters, not diesel. And so platinum is used for diesel, Palladium is used for gasoline. So China is the biggest market. And as China has shifted towards more electric vehicle production, there's the demand for Palladium has gotten hit. That's well known, well into the thesis of a negative view on Palladium. And so this has been in the price for a while. And what it's led to is production declines and producers having to shut in capacity. The economics are not there to produce Palladium. And so a very well-known demand bear case has led to a supply response as producers have taken supplies off the board. The biggest driver now, at least for today, was this idea about these sanctions, because Russia is 40% of the global palladium export market. And so to
I
the
mean,
extent
these
that,
palladium markets, I mean, it's only 300 billion in size. To give you an example, gold's 16, 17 trillion, silver's 1.5, 1.6 trillion, and palladium is like a $300 billion market. So you've had like in the last 20, 30 years, you've had 1,500%, run-ups in palladium. You've had moves of 800%. So this is a very small market that can really catch fire, and when it breaks, it's still like right now it's not too late to
right.
participate. And
Yeah,
then
when you get little shifts of market cap moving out of big cap tech or out of equities and try to find a home in hard assets, because those hard asset markets are much smaller, you get
right.
outsized percentage moves. And so that's what we're seeing with gold. That's what certainly we saw that with silver last week and again this week. And now, today again and
And
more
then
recently
Craig,
into
that's the
palladium.
playbook, right? So if inflation keeps surprising to the upside, it's 2022 all over again, where you had the inflation get sticky and stayed up there. The Fed had to hike, but the bottom line is higher inflation moves money out of growth stocks into hard assets. Somebody, I had a great conversation with a portfolio manager in London, like I said earlier. He opened my eyes to something. He said, Larry, think of all the dollar denominated debt. There's trillions and trillions and trillions of dollar denominated debt in the world. And he's like, listen, that debt used to pay very, low coupons, low coupons. But now the average weighted coupon has been going up and up and up on treasury issuance, right? And so now these countries have a lot of cash. And because of the sanctions and against Russia, but all the sanctions against EM over the last decade, and everybody knows about this new BRIC, with the BRIC meeting this week, the conference in Russia, it's what he thinks they're doing is it's not like they're selling the bonds, but when they get the coupons, Craig, think about this. Think about all that debt and all those coupons that come in. And we're hearing that's one of the big drivers of gold is that
Yep.
central banks are taking that, there's all that cash is coming in and they're buying the gold and silver and hard assets, mainly gold, right? But
Yep.
that's one of the things that's been out there because, and that's the source of the income. That's the source. It's all this coupons coming from dollar denominated debt. And when you use that, what we talk about in our book, When Markets Speak, when you use the sanctions weapon and you bash, country after country after country over the head with the disgusting hubris in Washington, eventually there's a price to pay for that. In the case of Russia, okay, they deserve the sanctions, right? But you still confiscated property, and now there's an impact on that in the market, and that's what we talk about in the book. And I think that's one of the things
Yep.
that's kind of driving this move into hard assets.
Yeah. I mean, countries like Saudi Arabia or the UAE or India or wherever, I mean, more friendly nations to the US, but they're still going to be concerned about whether or not they eventually find themselves to be an enemy of the United States. And if you're an enemy of the United States, and we've proven here that we're willing to expropriate reserves and assets from other countries who we deem to be enemies. And so as these countries earn excess trade surpluses, they need to find places to store that wealth and store those excesses, and they're going to increasingly be looking to not put that money back into U.S. Treasuries. They're going to look
I mean,
for
if you're loaded to the gills with U.S.
right.
dollars, right? Let's put, like you say, and then you're getting these coupons from the bonds, right?
Yep.
Take the coupons, put them in hard. That's what's happening, and that's only going to continue. Craig, thanks. We're going to do a couple of shows a week. We're democratizing information. Craig is running the Discord chat, talking to the institutional investors, and then what's great about Discord, right? If you're a wealth manager, Craig, you're a wealth manager. You're on a golf course. You come out, jump into the chat with Craig and get a download in terms of what's happening. Or if you're on the road in a meeting, 2-hour meeting, it's late in the afternoon, get a cup of coffee, jump in the Discord chat and just get a download. Craig, it's fantastic. This Discord chat's right here. But Craig's doing this, we're running the entire chat. Can't see the language there, but it's a lens on that buy side conversation. And it's hosted by Craig Shapiro, somebody that's been on the buy side for over a decade at Point72 and at Osprey, and somebody that can really help democratize information. But thanks a lot, everyone. The Bear Traps Report, Craig Shapiro. Welcome to the Lens. Have a great day. We'll talk to you next week.